Good afternoon, ladies and gentlemen. Welcome to one of our last lectures. As you know, next week we're going to start with your presentation. And picking up from last week's discussion, we have seen how important the intermediaries are. And we are looking today at analyzing the banking sector. So understanding how banks work, what are the major assets and liabilities, and the major roles we have in the banking industries. And the key part in here, since the banks are so critical, as we have seen last week, in terms of funding all of the corporation, if you remember, we have noticed that the stocks and the equities and the bonds are not that large factor in the funding of the industries or the corporation, whether in Europe or in the United States. Still, the majority was coming from financial institution, uh, as we have discussed earlier. So, having that in mind, we need to understand how bank function, how they make money, and how we can keep the whole operation safe. And if we're looking at current events from and I'm hoping that some of you will be discussing that in their projects, we're going to see how banks also collapse, or what can we do, what kind of regulation can we have to make them not fall. So one of the statements that was always used in the previous financial crisis is the too big to fall. And how do we prevent these things? Between this chapter and the next chapter, and I'm hoping that the next chapter is going to be very interesting for those that are doing their project about the banking regulation. It has really nice discussions in there. That's why I'm not going to cover it myself, and I'm going to leave it for those that are picking up the project in that department or in that field. So let's go and start talking about the banking industry and how it works. So in this chapter, we're going to try to examine how banks attempt to maximize their profits. Uh, and we're going to focus our discussion on commercial bank. And however, that will also be applied to all of the other financial intermediaries like insurance companies and the others that we have seen when we were meeting together at the beginning of the course. The bank balance sheet. This is a critical part. The bank balance sheet is divided into two parts. The liabilities, and these have in them the deposits, the non-transaction deposit, the borrowing that the banks does. So the bank borrow from other banks and borrow from the Federal Reserve, and we're going to see that when we talk about liquidity management. And there's the bank capital itself. So whatever the owners had invested in the banks, the bank capital itself, and we're going to see that in terms of the into managing the risk of the collapse, the kind of role that capital will play. On the other hand, the assets for the bank are the reserve, and they play an important role because we have a legal reserve in here. Uh, Whether you're keeping any excess reserve or not, that's up to the bank to decide, and it has its positive and negative depending on the prevailing interest rate. The cash items in process of collection, this is when you do a check, when you deposit a check in your bank. Uh, Say I'm depositing in Chase a check that is coming from Bank of America. Once I put that check in, the cash is not moved automatically, so it will be cash items in process of collection. Uh, that's a large item, by the way, between banks. Deposits at other banks, these are the deposits from your bank into the other banks. So cash item in process of collection is the deposit, for example, from Bank of America into Chase, and the deposit at other banks is the deposit from Chase at Bank of America and others. The securities, and that's a major part that we're going to talk about, loans that the bank is issuing, whether to commercial, to residential, mortgages, so on and so forth, and other kinds of assets. To analyze this balance sheet nicely, we're looking in here at the distribution as of 2014, and I'm sorry I don't have the most current one, even though it's available for you if you want to analyze it online. And we gave you a source of where you can get the distribution. So we have the reserve and cash items the security is playing a second large role. If you notice here in the loans, real estate is one major part of it. And we have the other physical capital as part of the assets, so the building that they own or whatever they have. In here we have on the liability side, we have the checks, we have the non-transaction deposit, and that's large. The non-transaction deposit has the small denomination time deposits, the CDs, the long terms, the short terms, and so on and so forth, and the saving accounts. And then you have the borrowing from the bank, for the bank borrow in there, and you have the capital of the bank. Now, to understand how things go, let's look at what's happening in the balance sheet. So if you take a $100 cash and you try to deposit it in your checking account, that cash goes automatically into the vault. So it's not a cash, it's not considered a cash item in process of collection. It will be a cash item that goes automatically. Once you put it there, it goes into the vault. It gives you a credit for your account, so it becomes a liability for the bank, and it's considered right away as a reserve, as part of the reserve of the bank. Now, that may be slightly different if you are to deposit a check instead of cash, because that check, when you put it in the bank in your checking account, is not a cash that goes automatically. It becomes cash item in process of collection. It's not with the bank yet. But once it is processed and the credit was given to the bank at the end, it becomes an addition to their reserve, but a negative, a depletion of the reserve of the second bank that is being withdrawn from. So if I'm putting a check from Chase into Bank of America, Bank of America, after collecting the cash, will have an increase in their reserve, while Chase will have a decrease in their reserve and a depletion of the checking deposit from the person that gave us the check at the time. So the idea of making profit in the bank and how the bank is using their funds is that when you are putting the $100 in the checks, a $10 will go, say the required reserve is 10%. $10 is going to go as a required reserve, and you have an excess reserve in here that you can use in any way you want. The excess reserve is going to be taken and be moved into one of the options that the bank has. And it's not always a matter of loans. You can put it as security. You can put it as any of the other parts of the asset that we have seen above. So if you're looking here, you can put it in either in the loans, you can put it in the securities, you can put it in the other assets. So whatever you have in there that you want to use, you can move it. So we call that an asset transformation. It's selling the liabilities with one set of characteristics. These are the checking deposits that we have. These are the liabilities, and using the proceeds to buy assets with different set of characteristics. So you can have them as long-term, short-term loans. You can have them securities, whatever it is that is there. So the bank borrows short and lends long. That's the key part in here. Most of the borrowing of the bank are short term, and most of the commitment that they have in the large percentage, as we have seen before, are long-term loans that we have. So if you look back in here, we have the real estate is like 25% of the loans that is issued, and these are all, as you know, they are long-term. So in here, as we are discussing, if I'm looking at this part, I have several things that I need to keep in mind when I'm thinking about the banking industry and how it operates. So the first part that I have here is a matter of how do we manage the liquidity of the bank. I have these people, they have deposited their money. I have these people with CDs. If they request their cash, how can I manage the liquidity that I have? Keep in mind, if I have too much excess reserve, I'm losing as a bank from two things: the money creation piece that you all know about it, how banks create money, and the interest that I get from lending this amount out. So the excess reserve is not giving me any profit in there. However, the excess reserve is giving me a guarantee that if I have people in groups coming to ask for their money, I can satisfy their needs. So I would not violate the reserve requirements. The other part that we have to think about is that I have a bunch of assets in here, and I need to keep a certain balance or a certain diversification in order to minimize my risk. So I need someone to help me out in asset management. So there's a position in the bank that consider asset management piece. And on the other hand, there's a set of liabilities that comes on this side, and I need a liability management. This part that is here, the bank capital, is such an important piece, and it was playing such an important role, and it always play a role in stabilizing banks in financial crises. I need someone to be able to figure out and manage and report to the government, because this is regulated under the capital adequacy management. When we get to this part here in terms of the loans, I need someone to be able to manage the credit risk. And figure out how can I diversify, and how can I have people willing to pay high interest on low risk, and so forth. And how can I minimize the total risk that I'm taking? And on the other hand, if you remember the chapter when we were talking about the interest rate risk that is there, that is created by the length to maturity and so on and so forth, I need someone to be able to also manage the interest rate risk. Let's take them one at a time and start analyzing these pieces together. So in terms of the liquidity management and the role of the reserve, I have to always keep the reserve requirement. So if the reserve requirement is 10%, I cannot have at any point of time any amount less than the 10%. That needs to be filled automatically. Anytime you go down, anytime there's a shortfall, it should be automatically eliminated. It needs to be eliminated. That's why it's a required reserve. And that's why it's audited, it's controlled, and we always keep an eye on it. So here we go. Assume that I have $100 million deposit, and I think I am assuming that I have a 10 million in the bank capital. So I have a total liabilities in here of 110 million that I can work with them. I can keep reserve of 20 million, even though I don't need to, because it's 10%. So if it's 110 million, I need to keep only 11 million. Say I keep 20 million in reserve, I give 80 million as loans, and I have a 10 million of security. I'm good, I'm happy. Now, say that I had a withdrawal of a 10 million. Okay, so I have a withdrawal of 10 million. I have a 90 million in here, 10 million in capital. So I have all in all 100 million. I need to keep a 10 million because that's the 10% in reserve. I have the 80 million. I have the 10 million. I'm still fine with this one. So I had the reserve. I was able to satisfy the withdrawal. I didn't have any issue in there. So the liquidity management in this case used the excess reserve that they have, and they didn't have to panic about it. The problem becomes if I have a shortfall. So for example, if I take my 110 million, as you can see in here, and I don't keep any excess reserve whatsoever. So I put a 10 million in the reserve. That's the requirement. I have a $90 million in loans, $10 million in securities. And here we go. I have someone requesting a $10 million, and I deplete 10 million from my deposit. So now I have in here a 10 million. To pay these people the 10 million that they requested, I have to take it from my reserve. Where else am I going to get it from? I mean, the reserve is the cash that's satisfying the cash in collection or the withdrawal that are happening right away. So I take the 10 million and I pay it out. So now my reserve is zero. I'm not satisfying the reserve requirement. My loan is 90 million. My securities are 10 million. And I'm asking myself the question, how can I get the 10 million reserve requirement? Keep in mind, if there is a shortfall, it must be eliminated immediately. So as we have seen in here in the previous one, the excess reserve that I had played like an insurance for me against the cost associated in filling the gap that is created in this case. So the excess reserve has its positive, but has its cost too. The cost of the excess reserve is that we're losing on the interest rate that we can get from lending it. So the deposit outflows when people take their money out. The excess reserve in here played the role of covering that gap. The excess reserve did not exist in this case, and I have a problem that I need to fill it in. Let's think about it. How can I fill it in? I have I need a 10 million to come to this piece. It can either come from selling out the securities, borrowing, let the bank borrow a 10 million in here and put it all in excess reserve, or selling $10 million worth of my loans to other banks that are willing to take. And if you remember when we were talking about mortgages, we talked a lot about selling it in the second market, the Fannie Mae, the Freddie Mac, and the others. And we have seen how we can bundle up for the different portfolios. So that's an option for the bank that they have. The other part is to call for loans and eliminate them, and that's really painful. So we have several options then. We can first borrow. So the bank can go ahead and borrow from other banks. I have 90 million. I need 9 million as reserve. Okay. Keep in mind, I'm going to correct myself on something in here. When I said I have in here 100 million, I do not need to have 10 million as reserve. I don't remember if I said that or not. I may have said it by mistake. If I have 90 million, I don't pay reserve on my capital. So if I have 90 million, all what I need is 9 million of reserve. That's 10%. So I can go ahead and borrow $9 million. Take the $9 million automatically from here and put it in the reserve. I'm not going to do anything with it other than that. The cost of this one is the interest rate that I as a bank have to pay to borrow these funds from the other banks. So we can either have, if you remember in the money market, the overnight loans, the repos that we have discussed, borrowing from other banks. We have to pay interest to cover ourselves. And if you remember on the repos, we discussed that as being one of the main tools to cover ourselves for the reserve requirement. The other option that I have is, instead of having $10 million of securities, forget about the borrowing. I don't want to pay that. I'm going to sell the securities. I'm going to sell 9 million of the securities, put them all in the reserve, and keep 1 million in here. The cost of selling the securities, the brokerage, and the other transaction costs that we have seen in the previous chapter. However, as you know, the bank is a large entity, and we have seen that they have a low cost. Still, it's a cost that they incur. Depending whether that cost is larger or smaller than the opportunity cost of lending the excess reserve, the liquidity manager has to make the decision whether they keep it or they just stay at reserve requirement. The other part that we have here is to borrow from the Fed, and that's the discount rate, if you remember from the beginning when we talked about the Federal Reserve. So all in all, the liquidity manager is looking at the reserve requirement, is looking at how much they have, is trying to control the deposit outflow, and thinking, okay, how can I cover that reserve hole that I have? And as we have said, we have different ways of doing it. Either borrow from the Fed for discount rate, borrow from others, depositors or banks, and pay the interest rate that's there, sell your securities or part of to cover your reserve requirement, or the most painful piece is to eliminate some loans. Now, we can either bundle and sell, and usually if they sell them, you're going to sell them at a substantial discount. If you're going to call your customers and tell them, look, I have to liquidate this loan that you have, that you're going to lose a lot of customers that way. So usually banks try to avoid calling in loans and destroying these parts. I mean, they try as much as they can to sell the loans to other banks or to the secondary market and move on with it. Now, this is the liquidity management part. The asset management part, the role for it, is to find the highest possible return on the loans and reduce the risk. So we need to have three things for them. I need to have an adequate liquidity. So we have to think of how we can distribute our funds. We need to put our loans in the best one that we can, which will give me the highest payment with the lowest risk. And I need to be able to also find the best securities that I can get. They have 4 tools in their hand. So we have 3 goals in our mind. We have 4 tools in our hand. Find the borrowers with the best credit rating that will pay high interest and have low possibility of default. So we're trying to match those that have great rating. If you remember, we have discussed these in the last chapters in terms of the loans and the also with the covenants, and we're going to talk about them in a couple of seconds. So we need to figure out those that have the best rating with the lowest possibility of default. So we're working with the adverse selection problem. And we're going to have to try to charge them the highest interest that's possible. On the second hand, we need to purchase the securities with the highest return and the low risk. And try to diversify all of your assets. Don't keep them all in real estate, for example. Try to diversify as much as possible and balance the need for liquidity against the increased return from less liquid assets. So you don't want to keep less liquid assets with you as much as possible. Keep in mind in here, in order to lower the possibility of default, we are dealing with the two problems that we discussed last week, the adverse selection and the moral hazard. The tools that we use in here are all of the restrictive covenants that we had for the borrowing agreement that we discussed. Now, the liability management part. The liability management is coming out because of the rise of money center banks. The expansion of the overnight loan markets, the new financial instrument, that's leading to the point that the checkable deposits, I mean the deposit accounts that we are creating, are not having the importance as they used to have before. So when I'm trying to manage the liability that the bank has, so if I'm looking now at the liability side, that is here, I need someone to figure out how we're going to distribute all of our liability and diversify them. So if the checkable deposit is not playing a major role, and as you can see, it's 11%, and the CDs are playing a more important role that you have, and you're trying to manage all of these at the same time. We have also people that are borrowing. I mean, the bank is borrowing to satisfy the excess reserve problem that we have. And the liability management is not going to work with the bank capital. That's going to be dealt separately with a whole different requirement that we have. We call that the capital adequacy management. This is a very important piece because the capital itself is the security for the banks when they collapse. Think about it this way. I'm running a bank. Let's call it the fraudulent bank. I have a crook they came together. They decided to open a bank. They didn't put any capital whatsoever in there. They took all of the deposits. They are running the business a little bit well at the beginning. They have very low capital. They spread themselves thin. And then if there is a default on 5 million of capital, what's going to happen? 5 million of loans, not of capital, sorry. The capital, you cannot default on it. So we started with a bank that has 96 million of deposits, 4 million as the capital. I have the reserve. I have the loans. I have a default on loans. That default on loans, where is it going to be coming from? Now the capital becomes a negative 1 million. You have nothing in there. Everything is gone, and it's going to be depleted from somewhere else. While if I'm working with these people, if I have a problem, I'm still positive on the capital. So which one of these two is a more secure lender or a more secure depositor, more secure bank? Now these, at the end of the day, when there is a crisis, the only problem that we're going to end up with is they have no risk in here anymore. I mean, the capital was low at the beginning. It's now gone, which is fine. But the whole risk is going to be carried by the depositor. So the idea of the capital adequacy management is to figure out how we can manage the capital so that we can keep the bank alive and providing our depositor with securities. The problem with the capital is that the more you have of the capital, the less return on equity you have. So if I started with people that are investing $4 million and the bank is making $100 million of profit, then you're doing 100 over the 4. Everybody will be taking 25 million on the return on equity. So the idea in here is that the profit is generated, the net profit is generated from the assets. So let's look at the relationship between those. The return on assets is the net profit after taxes divided by the whole assets. But the return on equity, and that's what the investors are interested in, or the shareholders are interested in, is the net profit after tax. Remember, these are the same, net profit after tax, but divided by the equity capital. So the first one is going to be divided by the total assets that you have, while the ROE is divided by the capital that you have. Now, the relationship between these two is given by the EM, the equity multiplier. The equity multiplier is the amount of assets per equity capital. So if I'm looking at the net profit after tax divided by equity, which is the ROE, it will be the ROA times the asset per equity. Now, if I have more equity capital, so this is going up, then the whole fraction, the whole ROE is going to be going down. So there's an inverse relationship between the amount of capital that you have here and the ROE that you're working in. There's a trade-off between the safety and the returns to equity holders. The idea is the higher the equity, the safer the bank is, but the higher the equity capital, the lower the ROE is. So the trade-off that is here, we will benefit the owners of a bank by making their investment safe. So the bank is not going to go belly down. It's either that the bank, in the case of the negative million in here, is going to end up shutting down and the shareholder are going to lose everything, or is going to start a fraudulent behavior, and we're hoping that it doesn't happen because there's a lot of regulation in there. At the end of the day, it will have to collapse. So the trade-off that is there, it benefits the owners of a bank by making their investment safe, but it is costly for them because the higher the bank capital, the lower the ROE. And the choice between these two depends on the state of the economy. At the time of the financial crisis, if you have a negative capital balance at the end of the day, you have to figure out, you have to get some more investors to come in. And in times of financial crises, you cannot find them that easily. As one of the things that you may want to discuss when you are doing your presentation, and since I have few of you that have selected the financial crises, is when there is a credit crunch, the shortfall of bank capital led to slower credit growth. And the idea behind it is that the huge losses from banks from their holding of securities backed by residential mortgages ended up with losses that reduced the bank capital, but the bank were not able to raise more capital because people, are afraid of the whole financial crisis that's there. So the bank could not raise much capital on a weak economy, and they had to tighten their lending standards. Now remember, the capital that is there, when you have capital, you can use the funds for it to satisfy the assets piece. So if this is depleted, you have to deplete on the asset part. Remember, we have to have a balance between these two. So if this is gone, part of it is going to be offset from here. So whether it's triggered by this side at the initial piece, and I hope that you guys can analyze it in your project, whether it's triggered because I had default on the loans and then it depleted the capital piece because I couldn't take it from the deposit. The depositors, I have to take it from the capital, but then a reduced one have to satisfy and have to reduce the lending portion again. So that was the cycle that we had seen during the financial crisis. So banks couldn't raise much capital in a weak economy, and had to tighten their lending standards and reduce the lending. Managing credit risk is very critical. Also managing the interest rate risk. So under managing the credit risk, keep in mind that this is what we were talking about a few minutes ago in terms of also having the asset management part. You want to ensure that you have a low risk and high paying customers. So the managing credit risk is going to be doing the screening and the monitoring. The screening is to work with the adverse selection. The monitoring is to also work with the moral hazard part and enforce all of the restrictive covenants. So the managing the credit risk and the management of the assets work hand in hand at all time. We are looking in terms of the managing the credit risk to create the long-term customer relationship and to have strong loan commitments and really work on having the collaterals that are there and work on be able to how to manage these collateral in case of default. Credit rationing is a major part in this game. I'm not going to talk much about the managing the interest rate risk. That's because we discussed it heavily before. I'm going to leave the remaining parts of the presentation for you to use it for the projects that you guys are doing. It is interesting to talk about the gap and the duration analysis and tie it down to the current events in your project. It's not that many slides that are there. The off-balance sheet activities are also major, and they create the agent principal problem in the banks. So these are all activities that you do behind the scene that the bank can make a lot of money out of them, and it ties also back to the next chapter with the regulation. Ladies and gentlemen, I will meet you in our Zoom virtual classroom around 7:30 to discuss the project a little bit further and to answer any question that you may have. Please enjoy the presentation. I want you to work on the PowerPoint that is attached and try to understand it well. Ask any question that you may have. I'll see you soon.